informations about financial performance. So of course the role of accounting is to give an information about the financial performance of the company during the financial period. So how much the company have earned. Well, it help us to compare what is the profit in the previous year, what is the profit in the current year, how far, whether there is any uh, variations where the company have to take a call. So these all things can be studied. So of course it provides information about financial performance, provide assistance to the management. So when a management want to take a decision or plan any particular projects or assets to be uh, used or purchased or anything, so accounting will play a vital role for management to help them in a decision making. Then accounting facilitate as a comparative study. Yeah, so it is recorded every financial year. Balance sheet is being prepared, a P&L is prepared. So it helps us to study the previous year how it is, the current year how it is working. So comparative study is possible in accounting, and it helps in settlement of tax liability. Of course, the systematic of accounting is very important when we are paying a tax, because when you have proper system of accounting, you will know what is the profit, how much is the tax to be paid. Yes, and helping loan. So if you want to get a loan from a bank or anything, you need a proper financial statement. If there is no proper financial statement, the maybe it will be very challenging for us to get a loan. So for raising of loan also, the accounting plays a vital role, helpful in decision making. So accounts helps the management to take a decision, and substitute of a human memory. Yeah, because you cannot keep recollecting what happened. Maybe in a day around 20, 30 transactions are happening, but when at the end of the year, where you cannot recollect all the transactions. So it is also one of the substitution, because whenever then and there you record the items and it is being recorded everywhere. So not only in the current year, even when you want to refer it later on after 4 years or 5 years, it will give a clear picture. So it is of course a substitution for a human memory, and it helps in the valuation of business. So in case of shutting down or the company is dissolved, so accounts will help us to evaluate the value of the business. Yes. So these are the some area, or you can consider as an importance of accounting or benefits of having an accounting. Then the drawbacks, limitation of accounting. Accounting is not precise. So it can be also subject to personal bias. When I record, there is a possibility it can influence the person. So that is also another thing. Accounting is done on historical value of assets. It is not taking the current value. It always records their historical cost, which means it deduct the depreciation. I would have bought an asset of 5 lakh rupee 4 5 years before. Still, I might be showing in my balance sheet with the same thing. So that is one drawback we can see in accounting. Then ignores the effect of price level changes. So account statement are prepared at historical cost. So it does not consider the value of money. So it ignores the changes in the value of money. So maybe 20 years before the 100 rupee, the value won't be the same at the present. So that is not being done. Then ignores the qualitative information. Of course, the impact of it measure only quantitative. It accounting records only in monetary, in numbers. So it does not take qualitative, the feeling, the emotion of an employee, that also can have an impact on the running of a business. Okay, the many qualitative aspects will also affect the growth of an organization, or it also increase the betterment of the organization. So it does not measure any qualitative aspect. That is one of the drawback we can see in accounting. Affected by window dressing. Window dressing means it is nothing but manipulating accounting. So to show my business in a favorable position, I can manipulate. There is a possibility of manipulating or even to reduce my tax, I can show certain expenses very higher where it will show less profit. Especially if you see the stakeholders will be more interested in knowing the accounts of the which is of the investment of the company where they have invested. So this window dressing is done, can be done. So that is also one of the drawback we can see. Next, qualitative characteristics of accounting information. The first one is these are the attributes of accounting information. Reliability. Reliability means the information must be free from error or personal bias. So, if there is any personal bias, then you cannot prepare an accurate data. So you cannot record in accurate. So there should not be bias. Personal bias should not be there. Then relevance. To be useful, accounting information must be relevant for the decision makers. So what data required? Suppose if I am planning for some plan to be installed. So what kind of data I need? So cash flow, how much we have to study about that. So there should be relevance in understanding. Then understanding ability, information. Uh, so information should be disclosed in a financial statement. Yeah, in such a manner that is easy for understandable. Even for a layman, it should be easy for them to understand. So that is very important. Comparability. So both intra and inter comparison must be possible over different period of time. Yes. Next is accounting information. Accounting as an information system. You know the information system, how it works, input, process and output. Likewise, even in accounting, input is nothing but the raw data which we are getting from the raw data from the transaction what we have done, and processing it is through men and equipment, and the output is nothing but your reports and information. And yeah, there are various people are interested in knowing the information of a organization or the balance sheet. Of course, it is shareholders and investor because they are the owners of the company. Ma'am, they are not able to hear you, ma'am. Sorry, Anusha, can you? Yes, I couldn't hear you. Ma'am, your voice is breaking. My voice is breaking. Is it clear now, ma'am? So this theory aspects are I am just running through because since you all are science students, I will little spend time on how journals are prepared, ledger, because that is very important. Yeah, so I hope my voice is audible right now for everyone. Yeah, so these are the people they are interested. One is shareholders and the investor, because of course they are the investors. They need the data, they need the information, what is happening in the company, because the accounting they are the user information need for these kind of users. One is stakeholders, that is investors. Other one is creditor, who are lending money for the organization. So of course, whether that person or the company is in repaying position. So I need to know how far the company is working, what is the financial status of that company. Then next is employee, who are the part of the organization. So employees also, because they are more concerned because they need wages or salary, bonus, okay, or one particular profit sharing. So they will be also interested in knowing the profit of the organization. And second, next is government, because the companies plays a vital role for a government to take any what to say policies, to prepare any policies or anything. So even the government will be interested in knowing. And the last is management, because they are the main people who are working in the organization. They need to know what is the profit they have earned. They have to take a decision on that, and at last the consumers. Yeah. Next is various kinds of accounting. These are the different kinds of accounting. One is stewardship accounting. Now, early days, you can see There will be a people employed by a wealthy people will employ another person to know what are the assets, how much assets they hold, and to understand in a periodical basis. So that is one type of accounting. The next is financial accounting, where you record, it is all on a financial transactions. You understand the financial transaction of the company. You need a financial, where you study the revenue, assets and liabilities which are being commonly used in the financial accounting. So here you record all the transaction to understand the financial status of a company. So all your revenue, expense, assets and liabilities are commonly carried in this type of accounting. Yeah, next is cost accounting. So this cost accounting is used to understand the cost of a company. Yeah, so this cost accounting, here in cost accounting you will focus more on the cost concept. All will be studied on the cost concept. Next is management accounting. So here the management is an the little extended of financial accounting. Here it is used by the management. So it is the decision making all can be done. So they interpret the data, whatever in financial accounting, you prepare a financial statement, how is the company working, all this being shown. But after that, based on the financial statement, the management need to take decision on any aspect or extending their business or in putting more plans or anything. So for that, this management accounting plays a vital role, where you have many types of accounting which you study to understand and interpret the data. Next is it is a new concept of accounting which is called a social responsibility accounting, because even though we work more on the profit basis, but also social responsibility accounting is also very important, because in addition, apart from the business effects, the social effects also plays an important role. So the role of business in society is increasing. It's quite coming up. So it is very important to study this kind of accounting also. Next is human resource accounting. So here in human resource accounting is a it gives importance on the human resources. So knowledge, trained, loyal, committed employees, how far. So you measure, you identify and measure the data about the human resources, and this information will be used in an effective way. So in simple word, it involves accounting for investment in people and replacement cost, as well as accounting for economic values of people to an organization. Next one is inflation accounting. It is concerned with adjustment of value of assets and profit based on the price level changes. That is called as investment inflation accounting. Next is there are different this all accounting concept. So the next important term is accounting concept. So there are different types of accounting concepts we have. So here first accounting concept are business entity concept. Here in business entity concept, the accountant treat business is entirely different from the people. It is not one and the same. So they both are two different concepts. So even though I am the owner or I have started a sole trader business, so any money if I have withdrawn from the business, that will be recorded as a drawing. So it treats two are different. So it is not even though we are one and the same, but as per accounting, as per this, it considered both are two different people. Next is money measurement concept. So in this accounting, it is being expressed only in terms of money. So everything is being recorded, only the transaction which are in monetary aspect, it is being recorded. So the non-monetary aspect, even though it has an impact, it is not being considered. So it is only impact on the monetary. So the qualitative data are not being considered, only the quantitative data will be considered. That is what it is called as monetary money measurement concept. Yeah, suppose there is a quarrel between manager and the employee. So that will have an impact, of course, on the that day work performance. But that is not being measured in case of money measurement. In money measurement concept, it records only monetary terms, not no non-monetary terms are not being considered. Continuity concept. It is called as going concern concept. So it is assumed that business will exist long time, and even though the person may not be there, but still it believed that the business will be keep continuing. There is no end for the life of the business. That is why it is called as going concern concept. So it means it exists for a long time, and the transactions are recorded from that point. So there is so even the life of a person will end, but in case of company there is no end. So that is considered as going concern concept. So it exists. The life will exist only for limited period, but the recording of accounting will be keep continuing. That is what it is called as a continuing continuity concept. In another term, you consider as a going concern concept. And we saw about cost concept. So the transaction are entered in the books actually in the form of cost. Uh, Suppose a firm purchase a piece of land for 1,50,000, but it considered worth 3 lakh. But if you see, the purchase of land will be recorded only at 1,50,000. That is what it is called as cost concept. At what cost it is being recorded, that will be keep continuing. So it does not consider the change in the value, either increase or decrease, that is not being recorded. Only what is the value at the time of purchase, that cost is being recorded. Then accrual concept. So income or profit arises only when there has been increase in the owner's share of the asset of the firm, but not if the increase has resulted from money contributed by owner. So any increase in the owner's equity is called as revenue, and anything reduce the owner's equity is called as expense or else loss. So that is considered as accrual concept. Okay. Next is concept of conservatism. So financial statements are usually drawn on conservative basis. So window dressing, like showing a position better than what it is not permitted. It is not proper to show the position substantially worse than what it is. So this is all considered as conservatism. So in other words, you can tell the secret reserves which are not permitted. So this all are considered as conservatism. Next is consistency concept and yeah, materiality concept. There are many events in the business which are insignificant in nature. So materiality the concept holds the item's small significance need not be given strict theoretical correct concept. Say example, it is given a paper stapler costing 30 rupee may last for 3 years. The effort involved in allocating its cost over 3-year period is not worth benefit than it is derived from its operation. So the cost is incurred may be treated as an expense of the period in which it is acquired. Now we have so the very important thing is next moving to the journalizing entry. I will show you. The next is preparation of books of accounts. So the first we were discussing about various books of accounts. One is first there are two financial statement we prepare. So one is P&L to study about the profit or the loss of a business incurred over the period of time, and balance sheet to study about the financial position of the company, and cash flow. Cash flow statement, these all are mandatory accounts which should be prepared by the company. So cash flow statement which will help us to understand what is the inflow of a cash, how much is the outflow of a cash, because that is a cash is a part which is very important for running of a business. So these are the three mandatory statements which we prepare in our accounting. So accounting process involves various stages or steps. The first one is identifying the transaction. So you need to identify in accounts only the business transactions are recorded. So you need to see what are the monetary terms, what are the monetary items. So you need to identify. Then second, record the transaction. This is the accounting process. So we studied in the definition. So what is accounting? So identifying, recording of transactions. So journal is the first entry, first original book or book of original entry where you record all the transaction in date wise. So what happened in a day, everything will be recorded in that book. Then again after finishing journal, it will be transferred to different ledgers. So recording of transaction. Third is you are classifying the transaction. The beauty of accounting is to classify the business transaction. So you are classifying that in different groups or under different heads, and you are summarizing that accounts. So summarizing means you open an account you post that everything different transaction in that particular head, and you are summarizing and interpreting the data. Interpreting the data means you see the performance and you are giving your opinion, information, or you are doing an analysis on that. That is called as analyzing and interpreting of the data, and you prepare the financial report to the stakeholders or the users who are interested. Okay, so analysis of business transaction. The one is voucher, payment voucher, you have receipt voucher. So in payment voucher, usually you can see all the transactions which are expense, which or payment, which have been recorded. Receipt nature is which is used against the cash receipt anything you received. So those all are recorded. Transfer voucher is used to record residuary transaction, which means here an internal transaction or transaction not involving either on the cash payment or on the cash receipt, you can bring it under the transfer voucher. Say for example, goods are purchased on the credit. If the goods are purchased on the cash, you would have recorded there, but now it is on the credit. So you can record under the transfer voucher. Next is balance sheet. This is the overview of the balance sheet. Basically, if you see in balance sheet, there are two sides are there. One is left side and right side. So on your left hand side, you record liabilities on your left hand side, and on your right hand side, you record all the items of asset. So that is what you call it as balance sheet. So asset means here you can see these are some examples given. So as I already discussed, a balance sheet is always prepared from the point of view of business entity and not the owner. So you can see here, asset means machinery, building, motor car, investments. So this all are recorded. Whereas any loans are being given, any investment we have given, recorded. That all will come under liability. At last, your balance sheet should tally, which means your assets and liabilities should be equally tallied. Okay. Now there are classification of accounts. This is all very important as an accounts. You need to know what are the classifications of accounts. So the accounts are being classified into two different major categories. One is personal account, other one is impersonal account. So under personal account, you have three different categories: natural personal account, artificial personal account, and representative personal account. So what is a natural person? People like us. are considered as natural personal account, and artificial personal accounts are the organization, clubs, all these are colleges, institutions are considered as artificial personal account, and representative personal account, which are some persons such as wages outstanding, prepaid insurance. So this all are considered as representative personal account. Under impersonal, there are two category are there, real account and nominal account. So here under real account, it is all related to the assets and properties. So both the tangible and intangible. So tangible assets are which you can see, feel and touch. That is tangible. Intangibles are which you cannot feel. So examples, it is given tangible assets like building, plant, machine, assets, all are real account. Whereas goodwill, trademark, copyrights is all are real, intangible, and which comes under real account. Next is nominal account. In nominal account, you have all expenses and losses, income and gain. So what are the major three accounts we have? One is personal account, where all personal, it represent the person, either artificial or natural person, it represent that. Real account where it records all your assets and liabilities, and whereas nominal account it records all the losses, expense, income, everything will be recorded. Now you can see the rules for debit and credit. So the types of accounts are classified into three categories. One is personal account, second one is real account, third one is nominal account. So what is a rule? Always I told we follow double entry system, which means every debit there is a credit. So there will be a credit in every debit. So personal account, debit the receiver. This is the golden rule we call. So always whenever we record the transaction, we always follow this golden rules of accounting. So in personal account, debit the receiver, credit the giver. So which means whoever example, we'll explain that. Debit the receiver, credit the giver. Debit what comes in, credit what goes out. So any item which is coming inside, say for example, received cash from X. So if you received cash, what is coming inside, that will be debit. Debit what comes in, and suppose cash paid. So cash is going out. So you credit the cash. So that is in real account. In nominal account, debit all expenses and losses and credit all incomes and gains. So whatever the expense and losses you have, it will be debited, and any income and gain, it will be credited. So these are the three major golden rules where everyone should know when we prepare a basics of accounting. So I think this golden rule you understood. First is personal account, debit the receiver, credit the giver. Second is real account, debit what comes in, credit what goes out. Third one is nominal account, debit all your expenses and losses and credit all your incomes and gain. Yeah. So here you can see here, let's move to dual concept, which means there is two transactions which take place. So let us see with an example. Now see, let us consider the following series of this example on the concept of dual concept. So Mr. Raghav further invested cash worth 4 lakh into business. The effect of transaction. Now Raghav have invested 4 lakh rupee in the business. So there are two transactions happen. One is investment, means nothing but capital for the business, and it is invested. So what is coming inside? Cash is coming inside. Okay, so cash will in asset side, you can see the cash is increasing. At the same time, it is also capital of the business, so the capital also increasing. That is what. So you can see an increase in asset is followed by increase in liability or equity, and vice versa. A decrease in asset is followed by a decrease in liability or vice versa. An increase in asset is followed by decrease in another asset and vice versa. an increase in liability is followed by decrease in another liability and vice versa. So this is called as this will always come. You can see here this concept. Here the liability is increasing, which means capital will be shown on the liability side. The liability also increasing. At the same time, the cash is also increasing. Next, Mr. Raghav repaid the loan in cash he took from bank for his office building worth 3,50,000. The transaction will be. So, what Raghav have done? He repaid loan in cash he took from the bank for his office building worth 3 lakh. So the loan he repaid. So what happened? The loan value have reduced. So there is a liability side. I told you all assets will be on your right hand side. All your liabilities will be on the left hand side. Now the loan have come down. So that is reduced on the liability side. At the same time, how the loan is paid? The loan is paid in the form of cash. So what happened on your asset side? The cash is also been reduced. So you can see when there is an asset decrease, the liability also decrease. When there is an asset increase, the liability is also increasing. Then third, Mr. Raghav sold the investment he made in government bonds for 2 lakh cash. In the transaction, RT made a profit of 20,000 as a gold bond were purchased for 1,80,000 initially. So investment in gold bond will reduce how much it is being invested as gold bond was purchased at 1 lakh. So investment you can see on the investment in government bonds, which is it will be reduced with 1,80,000, and cash have increased because Mr. Raghav have sold that investment for 2 lakh rupee. So the cash have increased in your asset side for 2 lakh rupee. At the same time, the 1,80,000 I sold it for 20,000. Correct. So there is a profit which I have incurred. So profit will increase will be shown on the liability side. So profit 20,000 which will increase in the capital. So any loss we show on the debit side which is on the asset side. Likewise, any profit we show on the credit side which will also increase in the capital which is on the liability side. So, hope you understood that. Next is accounting equation. So, remember the equation or asset is equal to liability plus capital. So, that is the accounting equation. There might be some questions are given. Let's see. Okay. Rule number 1. Now let us understand the basic rules used for recording changes in assets and liabilities and capital. First, for recording changes in asset, increase in asset is debited, decrease in asset is credited. Rule number 2, for recording changes in liabilities and capital, increase in liability and capital is credited and decrease in liability and capital is debited. So see there is an example. Let us see an example. On 1/4/21, let us assume that you have started a business on 1st April 21 with 5 lakh rupee in cash through your firm, myself. This transaction is analyzed as, so there is an investment which is being done. You have invested around 5 lakh rupee as for your business. So what happens in my asset side, the cash is increased, correct? Because I have invested means the money is being deposited, money is being put in the business. So there is an increase in your cash balance. Okay, that is on the asset. At the same time, I have invested that money as a capital. So capital will come on your liability side. Why it is considered as a liability side? Later on, that capital should be given back, right? So that is being considered as on the increase in liability. Okay, so you can see debit, increase in asset, credit, increase in capital. Journal entry. How you record, you leave all those things. You can see there are three golden rule which we explained. Debit the receiver, credit the giver, debit what comes in, credit what goes out, debit all expenses and losses, credit all income and gain. Now when you start a business, what is coming inside? Cash. So debit what comes in. So I am debiting cash account 5 lakh rupee. Credit what goes out. Here, whose capital? X capital. Credit, debit the receiver, credit the giver. So, capital is being recorded. Then, here there is, in a nutshell, they have given increase in asset, debit, increase in liability, credit, increase capital, credit, drawings, debit, expense, debit, revenue, credit. And decrease in asset, credit, liability, debit, and capital, debit, drawings, credit, expense, credit, and revenue, debit. So let us see this question illustration. Analyze the transaction of Miss Sunil and company for the month of March 21 on the basis of double entry system. Okay. So transaction based on double entry accounting equation approach, traditional approach. Okay. First, Sunil introduced a cash of rupees 40,000. So there is an introduction of cash by the Sunil, who is the owner, who is called as proprietor. So here two items. Cash is received, investment done by the owner. So cash is nothing but the asset, and investment done by the owner, it is considered as capital. So here the debit is increased, the asset is increased. So what it is there, when asset increase, you give a debit. So asset is increased, so we are giving a debit, and credit increase in capital. So credit also increase. So you can see here credit increase in capital. So here the likewise cash deposited. Second transaction is cash deposited in Citibank 20,000. So cash deposited in Citibank. So here the bank balance, Citibank I have recorded. So my cash have reduced, but at the same time my bank balance have increased. So I have taken the cash and went and I have deposited in bank. So my bank balance is increasing, but at the same time my cash balance is coming down. So bank is an asset, cash is also asset. When asset increase, you are giving a debit. At the same time, there is a decrease in the asset. So you are giving a credit. Okay. Then loan from Y, 5,000 rupee. So you are getting a loan or you borrowed a loan from Y, which is 5,000 rupees. So what is the entry? Cash account data to loan, Y loan account. So cash is coming inside of your business. There is increase in the cash, you are giving a debit. Okay, at the same time, the liability also increasing. Y loan account is being created. So there is increase in the liability. So you are giving a credit. Next, salary paid 3,000 rupee and outstanding 1,000 rupee. So salary for the services received is 4,000. Paid is how much? 3,000 rupee, and 1,000 rupee I am yet to pay. So here salary account, salary is an expense, and salary outstanding which I am yet to pay to an employee, it is a liability. So here salary, since it is an increase in expense, you are giving a debit, and there is increase in the liability, you are giving a credit. Now these are some example. Now traditional approach. So traditional approach is nothing but the rule which we used. Debit the receiver, credit the giver. So introduction to 40,000 of cash by proprietor. So here 40,000 is being invested by the sole trader or the proprietor. So cash debit, cash is received by business. Okay. Cash is what nature? Real nature. So real account, what it is given, debit what comes in. So what is coming in? Cash is coming. So you are debiting cash account. Then owner has given a cash. It is a capital account. Credit the giver. Who is the giver? The owner. But owner name is not there. So we are recording as a capital or X capital. That also can be recorded. Next is cash deposited in bank. 20,000. So here cash is deposited in bank. Debit what comes in, credit what goes out. What is coming inside the bank balance? Debit what comes in, credit what goes out. At the same time, bank receives cash, correct? Because you are depositing in bank. Bank is a personal account. Cash goes out. Cash is a real account. What is a golden rule of personal account? Debit the receiver, credit the giver. Here, who is the receiver? Debit, banker. So here, bank is being debited. Credit the giver. There is no giver, but there is a cash is a real account. So what is the golden rule of real account? Debit what comes in, credit what goes out. What is going out? The cash is going out. So credit the cash. Next. Loan from Y. So loan from Y, we are getting a loan from Y. So what, who is giving? Y is giving. What is coming inside? Loan in the form of cash. So there are two account comes. One is cash, another one is Y loan account. So cash is what nature? Real account. Whereas Y is specifying an individual, so it is personal account. So what is a rule? In real account, debit what comes in. So what is coming inside? Cash. So give a debit. And in Y is a personal account. What is the role? Debit the receiver, credit the giver. Who is the giver here? Y. So you are giving a credit to the Y. Any doubt in this? Anybody? Okay. So here some nature. Show the classification of nature of show the classification of following accounts under traditional and accounting equations. So there are different types of accounts they asked us to identify. So here the first one is building. So you need to identify first, that is all very important. What kind of account, what nature it is, that you need to know when you prepare an accounting. Now building. Building is a real account and it is an asset. Purchase, purchase is nothing but the goods. It's a real account and it is accounting equation is asset. Then sales, sales is a revenue. It is a debit what comes in, credit what goes out. Debit all income and expense. Debit all expense and losses, credit all income and gains. So it is a revenue. So and it goes temporarily to the capital account. Bank deposit, it is a personal and asset. Rent is an expense, so it is a nominal nature and it goes under the liability side. Rent outstanding, personal, and it is liability. So cash is a real account and if you see basically it is an asset. Then adjusted purchase, it is shown under nominal nature and it is also shown on the capital. Closing stock is a real account and it is an asset. And investment is also a real account and it is an asset. So there are various categories given. Okay. Now the next is journal entry. So journal entry is a transaction where it is a historical record of business transaction. The word journal entry comes from the French word jour, meaning day. So it is a book of original entry. We also call it as original entry. It is a primary book for recording every day-to-day transaction in a chronological order. So we record everything in date-wise. So when we start first, second, third, in that chronological order, we record the transaction. So this book is called as first book, original entry book, and it is recorded firstly in journal. Okay. So in journal entry, you can see the pro forma of a journal entry where you will have date, particulars, ledger folio, debit, credit. So hope date means the date which time the day it took place, that will be recorded. And particulars, in this column you can see we give, since we followed dual entry system, we give debit and credit. So according to the golden rules, we record the debit and credit. And ledger folio, which stands for LF, means ledger folio, which means the page of the ledger, which page of the ledger it will be mentioned, so that it will be easy for us to do the verification or go through where it is being recorded. And DR means it is debit. In this column, all debited amounts are being recorded. CR in short form we call credit. In that, all credit items are being recorded. So,
ma'am, excuse me, ma'am.
Yeah.
Ma'am, I have a doubt in capital. So, what all comes in capital, ma'am? Like only you told the investment and.
Yeah, basically in capital, if you see, if I am the sole trader, proprietor, if I have invested money, that is capital. But under liability, you will have capital. Any due, any loan or anything, this all will record under liability. So in capital, generally if you see, it is nothing but your own investment what you have recorded.
Okay, thank you.
Yeah. So journal, it is a permanent record and it is recorded in chronological order, first thing. And every transaction, there is one debit and there will be an equivalent credit is given. Okay, so that is what we do in journal account. So let us see. So there are different types of accounts. I just want to show you the entry. See, basically there is no need of mugging up of entries. You should understand the golden rule, so it is easy for us to record the entries. Say for example, see the question in this book, purchased, there is a purchase of transaction, purchased goods from, Okay. Now, there is a goods, leave the trade discount and all. You have purchased goods from X. So, if you see trade discount means from when you are doing, there will be some percentage of money will be discounted and the balance can be given. So, you purchase the cost, here you can see purchase of goods 8,000 at 15% trade discount, which means out of 8,000, there is a trade discount of 1,200 is being given. In 8,000, 15% you calculate. So, how the entry is passed is, there are two transactions happen. Purchased goods from X. So, you purchased and another one is, it is a goods from X. So, purchase is what nature? Here, purchase is you are debiting. Debit what comes in, what is coming inside here, the goods. So you are putting as purchase. Credit the giver. Here the golden rule will be mixed applied. So X is a personal nature. What is a rule in personal nature? Debit the receiver, credit the giver. So here X is a giver. So you are recording X. X as a X on the credit side. Okay. You understood? Next. In this, X owes 6,000 to Y. He pays 5,950 in full settlement. So, X owes 6,000 to Y and he is paying 950 in full settlement, which means there is a discount of 50 rupee. Okay. So, debit the receiver. Who is receiving here? Y. So, this is journal in the book of X. So, in X account, you will never record X data, you will record Y data. In books of Y, you will record X data. Now, if you see in the books of X, what will be the entry? X owes 6,000 to Y. So debit the receiver, credit the giver. So who is the receiver? Y. So Y is being debited. Then what goes out here? There are two transactions happen. One is the receiving person, giving person, another one is cash. So cash, how much is given? 5,950, because the loan is 6,000, owed is 6,000, but after discount you are paying only 5,000. So cash is a real nature. So debit what comes in, credit what goes out. So what is going out? Cash. So 5,950. The balance 50 rupee is considered as a discount. Likewise, in the books of Y, debit the receiver, credit the giver. So first here in Y account, who is giver? X. So X is a personal account. So what is a rule we apply here? Debit the receiver, credit the giver. So giver is X, so it is credited. Second, cash is another transaction. Cash is a real nature. Debit what comes in, credit what goes out. What is coming inside? Cash. So the cash is debited. What is the difference you are getting? 50 rupee. That is called as discount allowed. So you have allowed 50 rupee discount and it is been 5,950 is being received. This is how you record journal. This is how you journalize the transaction. Now here, goods distributed as a free sample. Goods costing 8,000 were distributed as free sample to record the transactions of it. Now, free sample means nothing but advertisement. So, what is going out here? The goods. So, it is a sample good. So, you cannot record as goods. You will mention it as purchase account. And advertisement, you are recording the debit nature. Next. So these all are the journal entry: depreciation on fixed assets, so depreciation account data to asset account. Bad debts. Bad debts means the debtor you have this money which is pending. That is what you call it as some debtor fails to make a payment. So that is called as bad debts. So which means you may receive or may not receive. Bad debt recovered means you consider that money you will not receive, but later stage you recover. That is called as bad debts recovered. So when you recover cash account debtor to bad debts recovered. So now here you can see bad debts to debtor account, because the whose debtor from whom we didn't receive that amount we are recording. Purchase and sale of investment. So investment account, when you purchase an investment, cash is going, so investment account debtor to cash account. And if you are selling it as cash is coming inside, so cash account debtor to investment account. So these are the some journal entries which we have in the books of accounts. So let us see this transaction. Yeah, journalize. Now this illustration we will see. Journalize the transaction of Ramesh and company for the month of 21. Balance on 1st March 21. Okay, cash 14,000. Bank balance 40,000. Stock 3,000. Sorry, 30,000. Furniture 10,000. Building 80,000. Data 6,000. Then B account 10,000. Bank loan 14. Creditors. Okay. Okay. Now 2nd March, okay, received 2,800 cash from A in full and in final settlement. So what is here? There are two transactions happen. Yeah, on first, previously somebody asked me how the capital is recorded. You can see here, journalize the transaction of Ramesh. So on for the month of March 20, the balance as on 1st March. So here cash account 14, bank, all these data are being recorded. So cash 14, bank 40, data 16. This assets all are given debit, and you can see the liability. What are the liabilities you have here? You have B, which is a creditor, how much? 10,000, bank loan 14, creditors 14,000, and then Y 16,000. So when you sum which is called 1,46,000. In journal entry, sometimes they give you like this. So indirectly you can find out what is the capital. So you are writing a narration. The balance of assets and liabilities are being taken up. Okay. So second is received 2,800 cash from A in full and final settlement. So on 2nd March, you are receiving 2,800 from A in cash in full settlement. Okay. So 2,800 rupees we are receiving. So that entry itself missing here. Okay. There is one more entry, ma. I think in textbook it is not there. You can correct it. On 2nd March, received 2,000 from A. So cash account, what you are receiving? One is cash and another one is A. Cash is real nature, A is personal account. So cash, real nature, what is the rule? Debit, what comes in, credit, what goes in. What is coming inside cash? So you will record cash account data 2. A is a personal nature. So what is the entry? Debit the receiver, credit the giver. Here A is a receiver or giver? A is a giver. So you need to give a credit. So entry will be cash account data to A account. I think that is missing. Then third, purchased goods of list price 10,000 at 10% discount on credit from Z. So you have purchased 10,000 rupee worth of a product with a 10% discount, which means that also not there. Okay. Yeah, so 10,000 at 10%. Third, sixth entry, what it is given. Purchased so entry is wrong. Okay. Purchased goods from goods of list price 10,000 at 10% discount. So 10%, 10,000 in that 10% discount. How much it will be in 10,000? 10% discount means 1,000 rupee. So you purchased goods at 9,000 rupee from Z. Okay. So what will be the entry? Here what is coming in purchase goods is a debit nature. So what is a rule? A real account. So what is a rule? Debit what comes in, credit what goes out. So here what is coming inside goods. So how in the form of purchase and credit the giver. So who is the giver? Z is the giver. So purchase account data to Z account, which means out of 10,000, 10% is discount. So either you can show it as 9,000. If not, you can even also show as a discount account together. So it is good always you can put that way. Next is third, fourth and eighth. On 8th March, sold goods to C on credit 8,000 rupee. So you are selling goods on credit 8,000. So what will be the entry? Here goods is going out and this who is receiving? C is receiving. So C is a personal person. So debit the receiver, personal nature, what is debit? Debit the receiver, credit the giver. So who is giver here? March C pays. So C is to be recorded. Okay. March C pays 7,000 after getting a prompt discount. So cash account data to C account. So C is creditor. And what is coming inside? Cash. And what is the discount? The percentage, 10% on that, 1,600. Next is salary. salary paid in cash. So salary account data to cash account, that is the entry. Okay. So what is it? Salary is an expense. So it is a nominal nature. So what is the rule? Debit all expenses and losses. So salary is being recorded as debit, and cash is a real nature. Debit what comes in, credit what goes out. So cash is going out. Okay. Next. What is the next transaction? Salary. Interest on bank loan 700 debited to the current account of the enterprises. So you can see here interest on bank loan debited to the current account of the. So what is going out? Cash, record as back. It is recorded credited on the current account. So interest on loan account is an expense. So debit and to bank account. So this is the transaction. Next is ledger. So once you are done with the journal, all the transactions are recorded in your ledger. Okay. So this is the format of the ledger. So there will be a particular head of account. In that head of account, you will record. So both the sides will be there. So one side is debit side, other on your right hand side you consider as a credit, on your left hand side you consider as a debit. So here journal, how you had date, particular ledger folio, here you will have date, particular journal folio amount. Likewise on the credit side also you have date, particular journal folio, because that reference you will record here. Now see the ledger, how it is recorded. Simple journal entry. On 1st August, goods are sold for cash. So now this is first, let us pass the journal entry for this. There are two items. Goods are sold for cash. One is cash, another one is goods, which is nothing but sale. So both are real nature. So cash, debit what comes in. So what is coming inside? You sold goods for cash. So cash is coming inside. So you are giving a debit. Cash account data to sales account. Sales is a credit. Why? The goods are going out. So sales you are recording. When goods are being purchased and sale you never record with goods account. You will mention it as purchase and you will mention it as sales. Okay. Now this is the journal entry we have recorded. Now how are we going to pass a ledger is, now two different head of account we will open. One is cash account, other one is ledger. Now in cash account you will never record cash, whereas cash you received for what? Sales, two sales. So two sales you will put it on the debit side. In cash account, two sales. If you see the journal entry from the ledger also, you can write a journal entry. Cash account data to sales account. Now if you see in sales account, sales is given credit. So in case what is given for debit in sales, cash is being given debit. So on the credit side, if it is a debit in your journal, you put it on the credit side of your ledger. If it is credit in your journal, you will put it on the debit side of your ledger. Okay. So here now sales is on your credit. But what is debited? Say cash. So in sales account, you are giving a to cash account on your credit side. This is how you post the ledger. So every debit and credit you will record in a particular head of account. Yes. Now you can see another question. Received 14,000 in full settlement of debt, 15,000 from Ram August 14, 21. Cash is received. How much you received? 14,000. In the debt of 15,000. So from whom? Ram. Ram on August. So cash account 14,000 you will debit. Who is the giver? Ram. So give a credit 50. What is the difference? 1,000 rupees is a difference. That is called as discount. So cash account data, discount account data to Ram account. Now if you see in cash account, you will record it is written in cash account. How much is recorded? 14,000. On what account it is recorded? Ram account. So cash to Ram 14,000 and cash in discount account also to Ram there is 1000 rupee. So because two debits happened. In RAM account, if you see, there are two debits are there on the top. One is cash 14, discount 1000. So in RAM account, I will write it as buy cash 14, buy discount 1000. This is how we prepare a ledger from the journal. Okay. So then when you can see detailed ledger chronologically you record on first, fourth, second like this, and then you balance. When you close the balance, you will call it as carried out, by balance carried out, which is on 31st March 2001. It is given by balance carried out, and that will be brought out to the next month. So it will be considered as two balance brought down. There is a typing error. It is two balance brought down 5000 rupees. That is how the ledger. So this two balance what you are bringing down, you will take it to trial balance, and then trial balance should tally. So I told you in the previous class, previous unit, there is journal, ledger, trial balance, then where you prepare P&L and balance sheet. So from this balance you record all in your trial balance and it should tally. Only then the recording has been done accurately. We can see here buy balance carried down 23,000, two balance brought down 23,000. Now you can see here illustration 6. Name the accounts prepared in illustration which do not, okay. So the same thing, it has been recorded and they closed the account and they bought it as carried down and brought down. So all item connected to cash will be recorded in cash, and all item connected to whichever the particular head, there you record all those items. See that previous journal, they have done a complete ledger and then they have done a summary of it. Every debit, credit, and then they will tally summary of the balances they have brought. Any doubt in this, anybody? You can tell me. Or else we will proceed for the next unit.
Will they give the solution, ma'am? Means how they will give? I didn't understand.
You didn't, okay ma'am. Which, if you can tell where you didn't understand, I can help you. Solution in the sense, the question will be given, madam. So sometimes they ask you to first prepare a journal and post the ledger. So you understood journal, right? Have you understood?
Journal means like what you have to prepare, like how much is the cash like that.
Yeah. Now this is, say for example, 1 minute madam. Now this is what you can see here, a simple journal entry. This is what you call it as journal. On 1st August 21, goods are sold for cash. So they have given one question. So they will ask you how to prepare a journal for this. So how will you do? There are two transactions done. Goods is being sold and cash you receive. Correct? So two items are there. One is cash, another one is goods. Well, goods means nothing but the sale. So first what you have to do, you should apply the golden rule. Cash, what nature? It is a real nature. Because we classified into three categories. Personal, real, nominal. So cash is a real nature. So real, what is a rule? Debit, what comes in, credit, what goes out. So what is coming inside here? The cash is coming inside. So we have given a debit. Are you getting it? And sales also, here we are giving a credit because the goods is going out. So the sales is being given credit. This is called as journal entry.
Yes, ma'am.
So in this journal entry, now cash you will open separate ledger. For sales you will open separate ledger. So in cash account you will never record cash. You will record the sales. Here it is cash account data to sale. Cash is done for what? Sale. Correct. You made a sale and you got a cash. So here in cash account I will pass it as two sales. And in sales account I made a sale and I got a cash. So it is not two cash, it should be buy cash. Buy cash 12,000 it will come. You will put opposite entries. For that we should be clear with journal. There are some illustrations apart from that. there are some questions have been given. You can just try solving, and if you want, we can discuss in the next class some one sample question you can try. Either question number 1 or 2 or 3, you can try so that we can, it's given as a self-assessment. You can try and we can discuss in the next class if you have any doubt in this 2 area. Next. So I request everyone, it is not in a day you cannot learn accounts, because it comes by practice. Even many number of times we practice, sometimes we do mistakes in passing entry. So I request all people, all these participants who are here right now, prepare, please do self-assessments, so that during class time, if you have any doubts on that, or after 5 minutes of the class, we can have a discussion on that, so you will get an idea. Because if it is daily class, stage by stage we can teach, but now it is, the slot is given only for limited, so we have to cover everything. So that is one of the disadvantage. So if any time if you have any doubt, you today we discussed 2 units, so you do self-assessment, just try only journal entry with what I told. 3 things you please look into it. One is, see the rule of accounting: real, personal, real, nominal. If you know that rule easily, you can do journal entry. Then once you are thorough with journal, ledger is of course it will be very easy. Next. I know it is very hard. Beginning of the class, many told you are from science background, but please go through that. Any doubts you can ask me anytime, or personally also you can ask me. I can help you out, not an issue. Passing a journal entry, other things. Okay, next we will move to financial statement. This is little more advanced. Okay, we'll finish at least 3 units today. Next we are seeing about financial statement. So in financial statement, the main objective of financial statement is to study the profitability of the company, to study the liquidity of the company, and also to study the solvency of the company. Profitability means how about the profit in the business. Liquidity means whether the company will be in a position to pay off the bills which has been created, or any liabilities which can be paid off. And solvency is a business ability to pay all its debts if the business were liquidated. The company is going to be dissolved. What will be the condition of a company? Whether the company will be in a position to make a payment or not. To study about that, to know about that is called as solvency. So the basic aim of financial statement is to understand these things. That is to study the profitability, liquidity, and solvency. So here under income, the basic concepts are expenditure. There are 2 different concepts: expenditure, revenue expenditure, and capital expenditure. Revenue expenditure are recurring frequently, and capital expenditure are recurring one time. And the same way receipts, capital receipts and revenue receipts. So capital receipts, when it is received from sale of goods and services, is all happening frequently, that is revenue receipt. Capital receipt means when it is contributed towards by the owner towards the capital of the business, that is called as capital receipt. Then you have accrual basis.
Ma'am, can you please repeat, ma'am?
Yeah. Which one you want? There are 2 categories of expenditure: revenue and capital expenditure. Revenue expenditure is which is recurring continuously. And can say, for example, salary. Every month we give salary. That is a revenue nature. And capital expenditure means once in a time it happens in a business. Say, for example, you are purchasing a machinery. So that machinery is a one-time purchase. So that is considered as a capital expenditure. Likewise, same in the revenue also, receipts, capital receipt, revenue receipts. So revenue receipts are, it's nothing but your sale of goods or anything frequently which has been happening, and capital receipts are one-time process. That is what you call it as capital receipt. And here, revenue expense, there are two categories, operating and non-operating revenue, and expense, revenue expenditures are there. Here there are few direct and indirect expense, means direct expense which incur directly, say for example on trading, fuel of the fuel charge, electricity, wages for an employee, in freight inward, this all are direct. Indirect expense means you consider as salary, all these things, indirect expenses, which comes in your P&L. So in financial statement, you have trading account, you have P&L. So you divide based on the nature of expense and you record. And operating means operating expense and non-operating expense are there. So operating expense are incurred for the running of the business, but not non-operating means it is not directly connected, but that is also needed for the business. Say for example, interest expense, loss on sale of fixed asset, this is all are non-operating expenses. Whereas in operating nature, you can see all connected with administration expense, office expense, selling expense. These all are directly connected to sale. So that is operating nature. So here you can see a format for P&L account, it is given. Yeah, and inventory valuation. Inventory valuation, there are two category inventory valuation is there, first in first out and last in first out. In short form you call it as FIFO, other one is called as LIFO. So here the valuation, the closing stocks are valued on LIFO or FIFO method. So whatever the inventory first, it will be discarded first, it will be sold first, and it goes like that. In a bin, it will be sold. Basically, this detailed things we study in costing, but right now just overview you understand, that is enough. So if first purchased will be issued first. So the last will be kept as it is. So it goes, first one will be clear, then it goes second one, it goes like that. Last in first out means it is called as in short form LIFO. So the inventory of the last one will be issued first. It goes like that. Then second last one will be issued. So that is LIFO and FIFO. You can see here opening stock 500 units. Cost of per unit is 15,000. Purchasing it is being done for 1,000 rupee. The cost is 4 rupee, 4,000 like that. Now they asked us to do FIFO and LIFO. So first 500, 1,500 is there. Okay. Then purchases happened as 1,000 rupee. Okay. So when purchase is happening, you will add. And when sales is going means the first item will be sold first. So that is what you call it as FIFO. So here January 10th, purchase of 1,000 is happened. Then again the quantity, how much is being sold on January 11th. January 11th you can see there is a sale of 1,000 rupee. So FIFO means the first quantity unit which is 500, that will be sold. The next quantity 500 later from then next when purchase happened 1,000 rupee, 1,000 units. So on 10th what is purchased, from that another 500 will be taken and the 1,000 will be sold. That is what you call it as FIFO. You understood? I will repeat once again. On January 500 there is a sale happened, okay, and purchase 1,000 rupee, 1,000 units again happened on 10th. So how you would distribute, how you say issue the stock is now sales on 11 January 11 there is a sale of 1,000 unit. So how the 1000 unit is taken? First 500 from on 1st January there is a stock of 500, and again another 500 will be taken from the stock of 1000. Okay, so like that it will go. So that is what it called as FIFO. And LIFO means it is like last in first out. So whichever at the last it will. So you can see the closing value in FIFO. You can see here the total sale 31,300 and here total sale the 27,300 on the rate at that rate, because it is being taken from the first slot, and whereas in LIFO it is going from the last. Then once the last slot is over, the second last slot is taken likewise. And closing stock. Closing stock is nothing but it is an inventory at the end of the year. So this terminology is all you need to know. So here how will you determine sometimes closing stock is your opening plus purchase minus cost of goods sold. You can come to know what is closing stock. And depreciation means which is wear and tear. Continuously you are using that machine. There will be depreciation. There will be wear and tear or some damages can happen. So you create a depreciation. Under depreciation there are two categories of depreciations we use. One is straight line method, another one is written down value method. Straight line method means default 10% depreciation I am creating, means every year from that asset I will create 10% of depreciation. Whereas written down value method means suppose I am creating 10% on 10,000 rupee means how much it comes? 10,000 into 10 by 100,000 rupee. After 1000 rupee reduce, there is 9,000 rupee. In that 9,000 only next year depreciation will come, which is 10%, nothing but 900. So it comes on the value, the written down value, on that the depreciation is calculated. Bad debts, I think you know, the debts which is not being created. Provision for doubtful bad debts means you are creating some portion of money. You know this there will be a bad debts. To safeguard that bad debts, you keep some money as a reserve. That is what you call it as provision for bad debts. And provision for tax also same like that. You are creating a provision for making a payment of tax. Now we are moving to profit and loss account. Yeah. So here you have gross profit. Gross profit means nothing but it is from your sales. You minus all your expense, cost of goods sold. What is cost of goods sold is nothing but your opening stock, your purchase, any other trading expense, everything you minus, you get your gross profit. So how will you find out gross profit ratio is, the formula is gross profit divided by sales into 100. Then operating profit, anything which you get, any profit which you are getting after deducting your operating expense. Say for example, from your gross profit, you will minus all your operating expense. And the difference what you get is operating profit. What is your operating expense? It is nothing but your salary, your administrative expense, selling expense, depreciations, all this which is connected to the business you will minus, and what you get is operating profit. Then net profit before tax. It means any profit which before paying tax you consider as net profit. Say for example, gross profit you got. From gross profit, if there is any other income, you add that. In that you minus other expenses. So you get the difference, what you get is your net profit. Okay, and net profit after tax means from your profit you are paying a particular portion of tax. Then what you get is called as profit after tax. In short, PAT you say, and earnings after tax. So income statement, so where you record all your income and expenses. So how the income incurred, how many purchase happened, how expense incurred, all those things will be recorded under income statement. So here, yeah, you can see this is the format of preparing trading and profit and loss. Now see the illustration 3. Let us illustrate the preparation of P&L from the trial balance with the help of, already the trial balance is what, after ledger preparation you get a balances. From that balance you prepare whatever the balances you are bringing, that will be put in your trial balance and then you tally, that is called as trial balance. Now the trial balance is given, additional informations are given. Closing stock 1200, outstanding rent 200. What is closing stock? At the end, the stock value during that period on 31st March, the stock value was 1200. Outstanding rent of the building, which means still the rent is not being paid. That outstanding rent is 200. Depreciation charged on machinery at 10% per annum. The depreciation means on machinery there will be wear and tear, there will be depletion is happening. So 10% we need to create. And prepaid wage. Prepaid means you paid in advance. So today I have to pay wage, but instead of today I had money in the previous month, I paid early. So that is called as prepaid wages. How will we record the entry? Okay. Now see here. You can see the first P&L format. This is how the profit and loss account looks. First is you have opening stock, purchase, wages, then carriage inward, etc. On credit side you can see sales, closing stock, etc. Okay, this is trading nature. Okay, what you get, the difference is called as gross profit. If it is on your left hand side, you consider that as a profit. If it is on your credit right hand side, you consider that as a gross loss. Then that profit will be brought to the next column and all your operating expense you will deduct. What you get is called as net profit or net loss. Okay. Now here, see the first capital is it will not come in your P&L account because it is an liability side. It is it will come in balance sheet on your liability side. Debtors also, it is not it is an asset which will come on your balance sheet. Machinery, which will be coming on your, which will come in asset side on the balance sheet. Creditor is a liability. Next is wages. Now wages is your expense, which is a trading expense. So wages means, what is wages? The money which you pay for a laborer. That is called as wages. So here wages will come on the debit side of your trading and P&L. So you can see here 2 wages on the debit side. You can see, hope everyone can see 2 wages. How much you got? 10,000. In that there is a statement given in point number 4, prepaid wages. Here you can see there is a prepaid wages of 400 rupee. Okay, which means already you paid. So in that case, you will not have prepaid that money you won't receive. Correct. So that money you have to deduct. Okay. So you can see here, from your wages 10,000, you are minusing the prepaid wages 400 rupees. That is over first entry. Next, purchase. Purchase is a trading nature. So on your trading account, you would have recorded purchase 19,000. Then third one is opening stock. So opening stock, always when you start, you will start only with opening stock. So opening stock on your trading account, you have recorded 4,000 rupee. Next, carriage in cash is a asset. It will come in balance sheet. Carriage inward, which is freight charges. So which will come on your debit side of your P&L trading account. Okay, this all are trading. Salary will come in your P&L account. Rent will come in your P&L. Sales is a direct. See, anything connected to the production, you will record under trading. Apart from that, any other item, you will record under P&L account. That's all. So now I recorded sales and I am putting my closing stock. That after closing that, what you get is your profit or loss. Now you are getting gross loss. Now that gross loss will be brought to your P&L account and then you are closing it and you are getting a difference. Now machinery, they said there is a depreciation on machinery 10%. So how much is my machinery here? You can see the machinery is 7,000 rupee. So in that 10% means, which means 700. So that depreciation, to depreciation, I would have shown 700 rupees. Okay, and there is a rent. Rent, it is given in the question 800 rupees. You can see here rent is 800 rupees. Here what it is given, there is outstanding, which means that rent is yet to receive. We have not received that rent. So here outstanding will be added. Please remember, some shortcut I'll tell. Any prepaid you will minus. Prepaid means what? Already you paid. So again you don't want to pay. So that prepaid will be minus. Any outstanding. Outstanding means which is yet to get. So you will add outstanding. So keep this all key points in your mind. So prepaid means you will add, and outstanding means you will minus. So this is how you get your profit and loss account. So only thing is you need to try working out problems. If at all it will be very difficult for you to understand this. Next is balance sheet. So in balance sheet I was telling, on your right hand side you will have assets and liability assets, and in your left hand side you will have liability. So what are the item will come under liability? Equity, any equity share, preference share, capital, reserve, debentures, loan, bill payable, provisions, overdraft, everything will come under liability side. Asset side, which is all your asset, either tangible or intangible, will come on your asset side. Now, yeah. So here a problem is given. We'll see some other problems are there or not. So I request everyone try working on these activities and see, and then find whether you are getting answer or not. There is an example to read about, or yeah. Any other examples are given? Let me see. Current asset. So what is current asset? The current asset means the asset which can be easily convertible into cash. So within a short time, when you are able to convert into cash, so it is called as current asset. And cash and cash equivalent means it is nothing but your liquid cash. Okay, liquid cash, paper cash, money market, anything which can be quickly converted into cash. Next is short-term investment. Short-term means which you have invested only for a period of 1 year, less than 12 months. That is considered as short-term. Account receivable is also called as sundry debtors. Debtor means you have sold goods on credit. The person who owe to you is called as debtor. Inventory means nothing but your stock. So your closing stock, what you have at the end, either opening or closing, that is also that is called as inventory. Prepaid expense means the expense which are paid in advance. So at the early, suppose today I have to pay the bill, but 1 month prior I paid. So that is called as prepaid. Fixed asset means the asset which is fixed in nature and which have a huge value, and the duration, the conversion is also takes more than a year. Say for example, fixed asset you can call it as land and building, plant and machinery. This all are considered as fixed asset because which cannot be easily converted into cash within a period of time. That is called as fixed asset. Then intangible asset, it's nothing but that assets which you cannot feel, which you cannot see is considered as intangible asset. Goodwill, copyright, patents, this all will come under intangible. Current liability means the liability which you have to pay within a period of less than a year. That is considered as current liability. Accounts payable means the person whom we are owed to, that nothing but the creditor, we consider as accounts payable. Outstanding expense, which means the expense which are due but you didn't pay. Now today I have to pay rent, but I don't have rent. I pay after 1 month. So that is called as outstanding. So due but not paid. This all terminology you need to know when you study what is accounts. Then income received in advance, which means priorly before the due you are receiving that. That is called as income received in advance. And provision for tax, it is nothing but a portion of money which is been kept aside for paying the tax at the end of the year. It is called as provision. Nothing but you call considered as a reserve. Then long-term liability, which is non-current liability. Under that, secured and unsecured loans are there. So it is more than 12 months. It is called as long-term. Contingent liability. The contingent liability means a liability which may or may not occur. There is no guarantee, but or in case if it is occur, to avoid that, for future safety, we as keep aside a certain portion that is called as contingent liability. And capital or owner's equity, nothing but the capital which is invested or the owner money what it is invested. Under equity, under capital, there are two category of capitals are there. One is equity, another one is preference share capital. Equity share capital means they are the owners of the company, and they don't get they get a privilege to vote, and they get dividend for the investment what they made. Preference share capital means they get a preferential right in getting dividend. Suppose the company is getting a loss, later stage the company is getting a dividend, means the first person who can enjoy that dividend is the preference shareholders. But they are not the owners, they don't get the voting power. Whereas in case of equity shareholders, they have the rights for voting. Reserves and surplus. Reserve and surplus means your profits you keep, general reserve, retained earning. This all are considered as reserve and surplus. That's it. Yeah, so thank you. So we have completed till now 3 units. I request everyone go through the 3 units, and if there is any doubt you can just personally text me, or else in the next class we can have a discussion on those areas, because accounts, and even though I explained a brief about that, until you don't prepare, it won't be easy for you to finish. I request everyone kindly go through. Any doubts or any help, you can reach me at any time. Yeah. So tomorrow also you have class. So kindly resume class at I think it is at 1 o'clock if I'm not wrong. So we will have class at tomorrow at 1 p.m. So kindly join for the class. Thank you. Thank you. So far any doubts? Yeah. Yes. Yeah. Thank you so much. So we'll resume back tomorrow as per the schedule. Thank you.